So let's kick it off with a number of headlines, not the least of which is Canada's economy is tanking, but at least investors have options. Well, I'm not sure quite what the investors is, but as I read through this article, I went, there's some really kind of poignant points that I think we have to pay attention to. Again, I come back to investing in real estate and looking at what's happening economically on both the US and Canadian side. And as I continue to say, real estate is still a play. You need to get your capital invested into assets, hard assets. Real estate remains that. But as investors, we have to look at what's going on in the underlying economy, stuff that we're not hearing about. This is finally an article that hits on some key points that I think we need to be aware of. So I'm sharing this particular page, and it leads with the Canadian economy is in some serious trouble if it stays on its current trajectory, as it has been the worst growth out of 50 developed economies since 2019, which flies in the face of what our government is saying. Now, I'm going to get a little political, but understand something. Forget about the politics of it. Underlying the politics is just really what is happening that we have to pay attention to. Again, our government is talking about how we're the strongest economy in the OECD, and we're just not. And this article goes on to say that this isn't a surprise because growth comes from capital investment, whether from Canadians directly or from foreign investors, and the environment here keeps getting less and less attractive. In other words, money is not coming into the country. Money is not into and investing in our real estate market as one example, but certainly even in our manufacturing and commodity market. Now, it goes on to say, well, government spending has nearly doubled to now account for almost half of our country's GDP. Bankruptcy filings here jumped 40% last year, and the Canadian Imperial Bank of Commerce said nearly half of Canadians have zero emergency savings. Now, we've talked about this in the past where we look at the demographic and the percentage of, let's say, middle or upper middle income into the very wealthy. That particular part or that particular sector of the economy seems to be doing okay. They have the cash, and although they're spending less and they don't have as much money, they're not struggling. You get into that bottom 60% of the overall demographic, and especially when you get into the service industry, it is just particularly getting slammed. It's getting hammered because of the cost of living. We go on to say that unfortunately, this is taking its toll on the Canadian dollar as well. So it's already fallen 13% against the US dollar since peaking in 2023, and is down to 72 cents. This means higher costs for goods imported from the United States. And keep in mind that Canada imported $277 billion worth of goods from the US in 2023. So when we look at what's happening there, the cost, again, we already know that manufacturing has slowed down. We know that construction has slowed down. We know a lot of things have slowed down already. Add to that the fact that our Canadian dollar has gotten weaker, 72 cents. And that means that companies are not investing in upgrades, for example, to production because of what they're paying for equipment coming in from the US. That's just one example. $277 billion worth of goods. That is going to slow down with a weaker dollar. Meanwhile, our government solution is to hire more government workers. Now, you've heard me shine a light on that multiple times. And over the past year alone, the sector has given approximately jobs to 180,000 workers, the public sector, which is more than the private sector and self-employed combined. Now, as you recall with the Bank of Canada, Carolyn Rogers came out and said,
we have an emergency, and that is our productivity is dropping.
And so aside from the fact that the government continues to hire public service or the public sector, we have to keep in mind is that is an administrative role. Those roles do not support productivity, and that's the issue that we run into. And then on top of that, when we look at what's happening in the private sector, and we'll talk a little bit about that later, is that we're seeing insolvencies and actual bankruptcies in the business sector spike quite dramatically, which means they're not hiring, which also means they're not being productive. So you can see this downward spiral continues. So government workers is growing almost 4 times faster than the private sector, and that 1 in 3 Canadians now work for the government, and they make 30% more in salary and benefits than their private sector counterparts. Now, that is a button for me. I won't go into it. But again, let's just bring it back to what it means economically. And what it means economically is that things are going to continue to slow down. So, on top of that, we have inflation. And it appears that inflation has been tamed, but St. I don't remember, I don't know how to pronounce his name, highlights that since the pandemic, Canada's official food inflation is up 25% and energy costs are over 30%, thanks in part to the carbon tax. And our citizens are now so overly taxed that it is impossible for them to get ahead. Now, what does this all mean? Now, we've shone a light on this many times over the past months of REIN It In, where we see inflation is slowing down. Again, when we look at CPI, it's a rate. Many talk about the cost, but it is actually a test or a statement of the speed of inflation. Now, speed of inflation has slowed down. And when you take out the shelter costs and the proportion of your mortgage being interest, it actually is less than 2%. So we're really anticipating the Bank of Canada lowering rates. One thing I've been 100% wrong on is, and I'm happy to be wrong, which was the Bank of Canada has in fact brought rate down a little bit, 1/4 point, and they expect another decrease. The market is saying there's going to be another decrease in September, as much as 50% basis point. Now, all of this is to say this. We've got inflation, but prices are not coming down. We go back to what I just said earlier, which is you got this cohort of individuals who are not in that upper income or even in the middle income range, and 60% of the population do not have discretionary income to spend. They're not going out, which again slows down the economy. Now, there's a point to be made here in all of this, which is that as rental housing providers, the cohort that we are actually providing for, as many are kind of higher income, that's becoming more common, 150, 180, $220,000 family income are now renting because they can't afford a house. The point is they can't afford to buy the house given the pricing these days. The point of it is this, is that we have to be very cautious about the tenant profile and the screening we do. I cannot stress enough is that is where the pressure is on. So we see a big demand for rental housing, but we also have to be really clear that the economy is slowing down. So the tenant profile, we have to be very, very cautious in terms of our screening and jobs, etc. Okay, so the problem is that the minimum income required to qualify for a mortgage on the average house in Canada is roughly $200,000. Now, that isn't the case if you go to Alberta. Now, a lot of these articles are driven out of Toronto, as in Ontario, GTA, surrounding area, and Vancouver. So we look at a roughly 200,000 is not the case in Alberta, not the case in Saskatchewan, not the case in Manitoba. When you look at the Western provinces and then some of the cities in outlying cities, for example, we're starting to see where the demand continues to be okay there. You're not having to make $200,000 to qualify for a mortgage. Now, the bad news in all of this, as this article goes on to say, is prices certainly don't appear to be getting cheaper. And when we look at it again, look at Ontario, which is really where these articles get focused on, nearly 200,000 people compared to only 36,000 home starts. So 200,000 people have moved into Ontario and only 36,000 home starts, which are largely one-bedroom studio condos and rental apartments. And that's according to Mike Moffat. So the point of it is that we continue to have this issue where immigration is strong, housing starts are not increasing, and if you get specifically into Toronto and the GTA, which we'll touch on, we have big problems in the condo market.
No! God, please, no! No! No!
So when we look at this immigration coming into the country, when we look at the economy slowing down, I'm going to talk a little bit about it as we hit on a couple of articles, but the point is Canada's economy is in fact slowing down. The options that people have for investment remain in real estate if you are savvy. Other than that, People are trying to go to the stock market, get into some form of alternative investments, if you will. But again, we just came off the long weekend. And what happened on Friday? The whole market melted down. It changed up again. People panicked. They got out. Now there's a huge call. We got to get the rates down. Whether that will happen in Canada or not, we don't know. Lots of pressure on the feds in the US. So it's a real mess out there. And ultimately, we think Canada will follow the lead of the Fed. So we'll see what they do in September. Will the US drop rates? Bond market says yes. We're going to find out. But in the meantime, we still have to continue to do what we're doing, given the rates where they are today. So when we see articles like this, there's a lot of great information in this. So beyond the headline, when you unpack this, you start to see some of the details. But let me know what you think. I look at the highlights of this, and there's some real relevant data here that impacts some of our decisions. And when we start to create the thesis for how we're going to invest, we need to look at this data. Let me know what you think of this article. So if you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.